Hello everyone. Today we're going to talk about the WorldCom Cynthia Cooper and internal audit fraud case. I'm Kylie Ramsey. I'm from Dover, Minnesota. My major is accounting and I'm a senior.
My name is Zach Cantor. I'm from Sartell, Minnesota, and my majors are accounting and BI, and I'm a junior.
Hi, my name is Garret. I'm from Coon Rapids, Minnesota. My majors are accounting and BI, and I'm a junior as well. I'm actually running for president today, so if people are seeing this today, vote for me. Kylie, do you want to give us a brief overview of this case?
Of course. So according to Dick Carsona in an article, Cynthia Cooper was just wanting to live a quiet life working for the pride of Mississippi. But as vice president of internal audit, she discovered some suspicious entries in the company's books. Her tenacious investigations uncovered the largest fraud in corporate history. This is what was going to bring this whole fraud case to one's attention. It was a case that took place in 2002, and more specifically what happened is the following. It was discovered accounting entries indicating large transfers of capital from the company's income statement to its balance sheet. With her team of auditors, Cynthia unearthed $3.8 billion of fraudulent entries. At this time in United States history, there wasn't a larger case than this. Briefly, in this case, just like stated previously, WorldCom accountants were demanded to move capital expenditures around in the accounts, leaving for the company to seem much more profitable than it truly is. This is when the uproar happened and WorldCom executives admitted to the fraud, resulting in them getting an atrocious amount of fines and faced prison time as well. After all this happened, it led to WorldCom having to file bankruptcy. Finally, it led to the act that is still in use today, the Sarbanes-Oxley Act of 2002, which was passed directly after this fraud case happened. We'll get to more details about this a little bit later and why it was put in place. Now that we know a little bit more about the case, who actually was WorldCom and what do they do as a company? Zach, you want to tell us a little bit more?
Yeah, I sure can. So WorldCom was founded in 1983 and quickly became one of the world's largest telecommunication companies through continuous growth and acquisitions in the late 1990s and early 2000s. WorldCom acquired MCI and rebranded as WorldCom MCI, which they enjoyed for a short period of time before they were caught in a fraud scandal. WorldCom provided long-distance internet and made most of its profit by acquiring other companies and leasing towers. So we know a little bit more about WorldCom. Kylie, do you want to go into a little bit about internal controls?
Yes, of course. So internal controls are defined as rules, procedures, and a routine that a company adapts to in order to prevent fraud and ultimately help them operate at the most efficient levels. This is what was formed after Sarbanes-Oxley was passed. It is stated by the University of California that an internal control is to ensure that information is reliable, accurate, timely, and that they are in compliance with applicable laws, regulations, contracts, policies, and procedures. There is a framework of internal controls that consists of 5 different parts. This is named the CASO framework, consisting of a control environment, risk assessment, information and communication, monitoring, and control activities. These take part in most businesses throughout the United States to ensure the businesses stay in compliance with themselves and the laws.
Well, internal controls are interesting, but do you want to follow up with some internal audit, Kylie?
Yes, of course. So following up after those internal controls, an internal audit is very similar, but in simple terms, it is evaluating how good a company's internal controls are and if they have any discrepancies within the company's financials or their business activities. Internal audit played a huge role throughout this fraud case and normally tends to have a huge role throughout other fraud cases as well. This can be seen in an article by Richard Chambers and Bruce Dorse with the Audit Board, as they state, internal audit has been seen as instrumental in detecting and investigating fraud, but not in proactive fraud prevention. This helps to show how important internal controls and internal audit procedures are for a company. So now that we know a little bit more about internal controls and internal audit, Garrett, can you tell us what actually determines a fraud case?
Yeah, of course. So fraud can be defined as an activity that relies on deception to achieve a gain. Fraud can come in many forms and for many different reasons. It can also be linked to a diagram called the fraud triangle, which has the 3 things that mainly contribute to fraud. So those would be opportunity, rationalization, and financial pressure. Financial pressure is when a person is motivated to commit fraud because they're in financial trouble or feel like they need the money. An example of this motive would be if somebody was struggling to pay off a large debt. Opportunity is when a person commits a fraud because they were given such a good opportunity to do so. An example of that would be if you're the only person that controls the bank deposits and checks for a company. Rationalization is when you come up with an excuse that makes you feel like committing fraud is okay. An example of that would be thinking that you're not really harming the company because you just take a small amount from the large company. Although seen as simple, many people don't actually know the definition of fraud. The difference between error and fraud is the intent of the action. Mistakes can be made without it directly being fraud, and nobody's going to be perfect in the workplace. The act turns into a fraud or into a crime when it's a knowing misrepresentation of the truth or a concealment of material fact to induce another into its act or its determinant. The largest way to tell if the fraud case apart from an error is the effort to hide or conceal the act. Most people who make errors wouldn't purposely try to hide the evidence. Zach, do you want to tell us a little bit about how the audit world looked in the late 90s to early 2000s?
Sure thing. So back in the late 90s and early 2000s, there was no AI. Programs for doing audits were very weak, and finding errors were limited as there was not much available to the people doing audits. So most audits and some recordings of accounts still happen by hand, so there was a lot of room for error and fraud. While there were computers and applications, they were not as involved as they were today. So now we know a little bit of the background and what fraud is. Kylie, what is this case specifically about?
Yes, let's dive into it. So the WorldCom fraud case is one that caught a lot of attention in and out of the accounting world. It was heard all across the world on national news and even on local news. This case was caught by Vice President of Internal Audit Cynthia Cooper, when there was $3.8 billion in fraudulent entries that the company's accountant was demanded to transfer from the income statement to the balance sheet, or in other words, turning expenses into assets. This was for them to increase their earnings, making them look better as a company. This happens in many fraud cases when financial statements are involved and being manipulated in order to make the company look better for not just the day-to-day consumer, but to the investors of the company. Companies do this to maintain their stock prices and make their earnings look good compared to other companies. At that time in history, once again, this was one of the largest fraud cases. Garrett, tell us more.
Definitely, I can. So, with this fraud that was committed, it came prison time for the CEO, Bernard Ebbers, who was the one who demanded the accountant to make the adjustments. So he got sentenced to 25 years. Along with Scott Sullivan, who was also the CFO, or Chief Financial Officer, Treasurer, and board member of WorldCom, who then got sentenced to 5 years. Not only do these two men face prison time, but there were also many employees who lost their jobs and were charged with fraud and conspiracy. The company as a whole faced fines and charges over $1 billion. Then about a month later, the company filed for bankruptcy. Overall, committing fraud did not work out too well for its company's leaders or the company itself.
Yeah, so now we know a little bit more about the case and what's actually involved. We're going to discuss what it was like for someone who went through this as an accountant. Kylie, would you like to read off the questions we asked Ms. DeSalvo?
Yes, of course. So the first question we asked DeSalvo in the interview was, what was it like being in the business world as the events of WorldCom and Enron were unfolding? What was the impact of these events on the day-to-day?
Yeah, so Professor DeSalvo responded with, let's see, Enron was 2001 and WorldCom was officially bankrupt in 2002. While I was working in new business development and negotiations for an international supply chain company, this was an interesting time because there were no real guardrails for businesses. For example, fraud was discussed. We all knew it was happening in more places than not. And if you wanted to change the way businesses work, you basically had a petition for it, and the changes were made. No intensive internal controls were present. Most people were shocked by Enron, and then a series of companies like WorldCom followed. I distinctly remember the discussions when Sarbanes-Oxley 2002 was floated around the amount of IT support that would be needed and cost to conform with internal controls. Then it was passed, and we all had to begin mapping out every process and logging everything. It was a busy time. If you think about it, SOX also initiated a new reporting structure.
Great, thanks, Zach. And then the second question we asked DeSalvo was, DeSalvo, you being an accountant with a lot of experience and knowledge, what is your opinion as to how the WorldCom case could have been prevented?
Yeah, so DeSalvo answered this one as, it is so easy to look back and reflect on it all since the information about the case is so well known. But in that time, it would have been more about watching the money. In most cases, a review of the financials would show a red flag. But there had not only been a willingness to say something and also in some ways the knowledge to make sure people understood the ramifications of manipulating financial statements. At the time, it was more about doing business and figuring it all out. There was a sense that people really knew what they were doing and nothing that far out of the line was happening. Again, we are in a completely different world now.
Great, thanks again. The third question that we asked DeSalvo was, if you were in the situation of Cynthia Cooper at the time, what would you have done? Would you have done the same thing, and would you have done anything differently than what she did, DeSalvo?
Yep, and DeSalvo's response was, I would have done the exact same thing. If you think about it, accountants, even if not, CPAs are held to a standard. If she would have said nothing, then she would have broken this and failed to protect the transparency to the users of the financial information. Again, the ones making these choices thought they were clearly dancing in the system, and it is important to know even a small dance around accounting is ethically damaging and, in most cases, fraud. So this is where most people lose faith in the accounting industry, and as you can see through someone who experienced these events while working in the industry. Kylie, now that we got a little bit in about that, who is Cynthia Cooper? We talk all about her, but who is she?
Yes, of course. She is an accountant that was raised in Clinton, Mississippi, where the headquarters of WorldCom was. She was also the vice president, once again, for the internal auditor for the company, WorldCom, in which she blew the whistle and caught the company committing the fraud, as described previously. So now that we know who Cynthia Cooper actually is, how did she play a role in this case?
Yeah, so Cynthia Cooper was a part of the sleuths who figured out the fraud and managed to expose the fraud to the SEC. So Cynthia and her team uncovered big transfers in the financial statements that looked suspicious enough to get help. So she then consulted KPMG, who confirmed that she had stumbled upon high-level fraud. She was the main whistleblower in the case, which led to the fraud change in SOX. So Cynthia later wrote a novel about the situation, which got a lot of attention in the business world. The book showed her point of view throughout the whole process and gave her insight behind the scenes. Cooper found these fraudulent activities by following the money, like they teach us in classes. She found that WorldCom was fraudulently moving capital across accounts, which ended up being more than $3.8 billion of fraudulent balance sheet entries. She felt that ethically she had to act on this fraud and follow the laws and regulations. She was a big advocate of moral rights and wrongs. So, Kylie, do you want to introduce the next point about... my bad. Next, I'm going to go into whistleblower protections. So, this case was one of the reasons that SOX was passed. It was to grant whistleblower protections for outlining their companies for fraud. So before this happened, there weren't many protections offered to Cynthia Cooper and her co-workers who helped expose WorldCom. SOX enforces that employees cannot be discriminated against because they exposed their previous company. They're also entitled to a job with the same seniority as their previous one, so they aren't hurt from it. They're allowed compensatory damages if there are any in the process. So the government realized that it's valuable to have workers feel secure about exposing their company and to have a higher chance of catching fraud. They're willing to use some of their power and a little bit of money to protect the workers who help them catch the fraud. It's worth it to them because usually the opportunity cost of finding the fraud will make giving these simple protections worth it to the SEC. This also allows them to find more different fraud cases that they couldn't without the help. They made it the right decision to allow workers to make the correct ethical decisions without having any corporate repercussions. So Zach, do you want to go over the impacts of this fraud case had on WorldCom itself?
Yes, this scandal ultimately ended up being WorldCom's downfall. As a result of the case, WorldCom reached a rough estimate about $2.5 billion settlement and filed for Chapter 11 bankruptcy. In the bankruptcy filing, they listed $107 billion in assets and $41 billion in debts. Although they filed bankruptcy, they're allowed to continue to pay their employees, retain some assets, even be given a second chance of starting again. However, the company lost a lot of credibility, along with many of its large clients, and in 2001, WorldCom created a separate tracking stock for MCI in hopes of isolating it from the internet and international operations. In May of 2002, they eliminated the stock and sold dividends to try and save around $284 million per year. This amount was actually only $74 million, and the company was dropped from the S&P 500. Later that year, the stock would be labeled as junk, and they were unlisted from the NASDAQ. And to further put on the damages, in June of 2002, that was when they got eliminated from NASDAQ, yeah. Finally, in March 2003, the company decided to write off goodwill and adjust accounts that were overpaid in the late 1990s, which is WorldCom's way of trying to correct past actions, but it was already far too late. WorldCom operated as MCI from 2003 to 2006, when the company became part of Verizon, where it still operates as part of Verizon today. So now, how did this actually impact the world, not just WorldCom? Well, this fraud case, along with the events of Enron and others, resulted in the creation of, like we said before, Sarbanes-Oxley in 2002. This case showed there's a huge problem with auditing and reporting in the businesses, and that it's something that needed to be fixed. So looking forward, how could this be prevented, and could this happen again, Kylie?
Yes, just like any other fraud case, one of the biggest things that could have helped prevent this fraudulent transfer of capital from the income statement to the balance sheet, or in other words, turning their expenses into assets, is to have better internal controls. Ultimately, this would help indicate that the company's financials are reliable, accurate, provide assurance, and lastly, they're in compliance with the law. It is important to have strong internal controls to prevent cases like this from happening with a successful company. Internal controls can benefit a company more than just preventing fraud as well. They help improve a company's productivity and throughout the process. When looking at the WorldCom case, you can see that the company did not have the most honest and ethical employees. I say this because they pushed their accountants, as stated previously, to change the company's numbers to make them look good for the American public, not giving a fully accurate picture of truly where the company sits. Therefore, in this case, it is not only a failure of internal controls of the company, but it also falls on the line of unethical procedures within the company and even on the accounting side of things. The accountants should be ethical within their work, even when being told to change the numbers. All in all, if everyone would stay ethical and truthful, a lot of fraud cases that have happened in history, they could have more than likely been avoided.
Oh, wow. That was some great information, Kylie. In closing, we want to just thank you for the time that you all took listening to our podcast. And we know that was a lot of information thrown at you, so let us know if you have any further questions or if you want to talk about the case more. You can contact us at grrotz21@smu.edu. The WorldCom case has been a lot of fun to look at since it was so impactful to the accounting world. I'll leave you with this one last consideration. What would you do if you were in Cynthia Cooper's shoes?